In the high-stakes world of finance, latency is the silent killer of profits, but most firms are flying blind when it comes to real-time monitoring. Today, I'll show you how MonitorLatency provides the clarity and control you need to turn latency from a threat into a measurable advantage. Let's start by understanding why this problem is so pervasive. The finance industry, especially high-frequency trading and quantitative funds, operates at speeds where nanoseconds matter. Your profitability hinges on execution speed. Yet, generic monitoring tools fail because they dump raw metrics without context. At quarantadue.ai, every MCP workflow starts from the real tool interface, not from a generic prompt. The goal is simple. Keep the expert in control while the system structures the evidence. Inputs, reasoning, and outputs stay connected in one reviewable flow. Now the results become easier to compare, easier to review, and easier to explain. They don't tell you how a latency spike affects your specific arbitrage strategy or your order routing logic. The real challenge is connecting latency data directly to trading outcomes and costs. This gap leaves you vulnerable during market shocks or volatility events. So, how do we bridge this gap? The technical method behind MonitorLatency is grounded in continuous real-time observation paired with deterministic analysis. We don't just collect ping times or packet loss data. We establish dynamic baselines for your unique trading environment. Key concepts you need to understand are latency attribution and impact calculus. Every microsecond of delay is attributed to specific system components, network hops, exchange gateways, or your own matching engines. Then, we calculate how that delay impacts the probable execution price of your trades given current market depth and volatility. A common misconception is that lower latency always equals better performance. Not exactly. It's about understanding the cost of latency for your strategy. MonitorLatency differentiates by providing strategy-aware insights, not just raw numbers. Now, let's dive into what the software actually does. MonitorLatency ingests latency metrics from all points in your trading infrastructure. It normalizes this data, establishes intelligent moving baselines, and flags deviations in real time. The core is its calculation engine. It models how observed latency would have altered the execution of your recent trades or live orders. It provides an audit trail for every alert, crucial for compliance and post-trade analysis. Furthermore, it includes scenario modeling capabilities. You can ask what-if questions, like how a 10-millisecond delay on a specific exchange would affect your portfolio's slippage. This is powered by historical market data and your own strategy parameters. Let me walk you through a hypothetical example to make this concrete. Imagine you're running a statistical arbitrage strategy between two correlated assets. MonitorLatency is tracking your network latency to both exchanges. Suddenly, it detects a 50-millisecond increase in latency to exchange A. The software immediately calculates the impact. Using variables like your typical order size, the current bid-ask spread on both exchanges, and the historical correlation decay rate, it estimates that this latency spike could increase your execution cost by 15 basis points on that leg of the trade. It alerts your team with this quantified risk, not just a red light. You can then decide to reroute, pause, or adjust your strategy in response. This is actionable intelligence. For compliance and reporting, MonitorLatency automates the generation of clear, stakeholder-ready reports. These reports translate technical latency events into financial terms that executives and regulators understand. They show latency trends, incident impacts, and risk exposures aligned with frameworks like MiFID II. The audit trail ensures you can demonstrate diligent monitoring and explain any anomalous trading outcomes. In closing, MonitorLatency offers a comprehensive solution to a critical but overlooked problem. It gives you real-time, actionable insights into latency's financial impact, reduces exposure, and enhances your competitive edge.